What's up, traders? Welcome to the CPI update video where I'll be doing a technical analysis and giving you my thoughts on the broad market, specifically SPY the Qs and IWM. Let's kick things off here on the SPY daily time frame chart, and then we'll jump on into our sectors and have a look at any other supporting evidence afterwards, including the fundamental data. Speaking of fundamentals, tomorrow at 2 p.m. Eastern time, don't forget, FOMC Fed funds rate announcement will be coming out, and perhaps the more infamous Jerome Powell press conference speech and Q&A to follow at 2:30. All of that's to say is that we are not out of the woods yet from a volatility perspective. Continue to keep an open and flexible mindset in terms of a wide range of possible outcomes here on the daily time frame chart. What we can read into is the bar that printed on today's session. We of course know that this happened primarily because of what took place at 8:30. The CPI numbers came out, and of course they beat the expectation to the tune of roughly 0.2 of a percentage point in both readings that matter, the month over month as well as the year over year. And, that's continuing to reinforce to the Fed that their tools, INF, are in fact working and inflation is moving in the proper direction. Don't get me wrong, a 7.1 CPI read, far, far, far from desirable, but I do imagine that Powell comes out tomorrow and just reinforces the idea that policy, of course, works with a little bit of a lag. It's not instantly going to go back to 2%, but the trajectory is ultimately what we care about here, and the market obviously saw that as bullish information, producing a sizable gap up of roughly 11 points on this morning's session. Now, it's not necessarily the gap up that is most noteworthy about this chart, but perhaps the location of the gap up, right? We've avoided catastrophe by essentially producing an equal high on the morning session and avoiding what we know was the primary concern, the head and shoulders, right? If we had gone high, lower high underneath the prior resistance at 402.50, daily 200 SMA, that's the green line in there, then as soon as we break down underneath 394.50, we would have confirmed a new daily downtrend. With this new equal high in place, you can start to look at this as much more of a neutral market environment. We've got two equal highs. We've got two sets of equal lows, three if you want to count these from back here. The market trend is really much more neutral, and even if we do break the bottom of the balance, there's still the opportunity for a look below and fail. Again, we're not arguing that this will take place. We're arguing much more for a neutral outlook here. But this is at least a possible outcome. To confirm a new downtrend, you would need a lower high and then back down underneath the low of the balance, right? So it's not that the breakdown has been avoided completely, but it's at least been delayed to some degree. And there's also the possibility that the gap close area offers a little bit of a daily higher low. Just a possibility. The primary thing that I would want you to understand and take away from this video is if we're in a balance range, and those of you who have been tuning in for quite some time know exactly what I'm about to say, if we're in the midpoint of a balance range, your edge does absolutely not exist right here. Your edge exists at the edges for a breakout or a mean reversion type trade, and the same is true but opposite at the bottom, mean reversion type trade or a breakdown. So I really don't think that the market produces a significant trending type move until we now get over 410 or under 394.50. Some other nuances that we can read into if we take a look at our hourly time frame chart and zoom in here, let's not forget that a gap up certainly produces thin to zero structure underneath us. The sellers did their job. They sold the market off. But where did we stop? We stopped exactly to the tick at the gap close area. So let me pose you this question. If a seller with a 3 to let's say 9 month time horizon is looking to enter a short position, are they going to necessarily stop at a gap close area, or is this much more indicative of short-term momentum type traders tiring out or short-term traders looking for a gap fill reversal type trade? I mean, as a short-term trader, I know exactly what I would be thinking. I would be saying, okay, if I'm short from the highs or if I'm short from the bear flag that was midpoint in here, I want to start looking to cover at the prior high of day in the gap close area. So to me, this is extremely indicative of short-term traders, not large money, OTF traders, as we call them, other time frame traders, entering the market with large size and looking for big bearish outcomes. And this pairs up quite nicely with the idea on the daily time frame chart that we should really be more neutral until this range breaks. The large OTF players may enter on a new daily downtrend developing underneath 394.50, or the OTF longs might say, okay, if we can crack back above these two equal highs, it's game on. We're through the resistance trendline from the all-time high. It's much more meaningful. So overall, I think that the argument on the daily time frame chart is for neutrality, which is probably the last thing anyone wanted to hear as we're moving into the FOMC announcement. I think the FOMC could be the catalyst to get us over 410 or underneath 394.50. But in terms of positioning early, I'm gonna sit on the sidelines for that one. Feel free to take day trades. Again, don't get me wrong, day trades, scalps in between here, absolutely. But the larger market momentum and seeing market direction really is coming down to 410 and 390, 450. So hopefully we've made the case for that. A couple of other additional just observations here. It's not really a make or break for the market. We're back above the CPI VWAP from here. That's the anchored VWAP there. That's also confluence of support for the gap fill. Same thing with the last Jerome Powell speech from, what was that, 2 Wednesdays ago, when he basically reaffirmed that inflation was moving in the right direction. Things were looking better. He was kind of right based on what the CPI printed. We're back above that VWAP, and we did reject. This is the all-time high. This is the anchored VWAP from the all-time high here. Okay, so overall, caught between a rock and a hard place, and being in the midpoint of range, I say neutral until proven otherwise. A couple of other data points that we can look at behind the scenes to help us build at least a little bit of a directional edge into the remainder of the week. Top right-hand corner explains what this is if you're not familiar. These are the market internals. In terms of the volume distribution, we were positive on today's session. Now, I get it. This reads in relationship to the prior day's close. So with the size of today's gap up, absolutely it makes sense that this would be positive. But if the stronger sellers were here, I imagine that on this attempt here, midday, back towards the zero line, they would have kept it driving lower, right? So let's just say at best, this might be neutral, which makes sense based on what we've been saying on the daily chart. Same thing happens here in the advanced decline line. This is in relationship to the prior day's close. Massive overcorrelation on the open that corrects. So we're not as concerned with an overcorrelated state here. But instead, remember that if this was going to be more bearish, it probably should have moved to the zero line. But okay, we'll concede that because it's in relationship to the prior day's close, the size of the gap kept it from getting to that zero line. And it really maybe reads as more neutral. Okay, fine. If this is going to be slightly more bearish than displayed, if this is going to be slightly more bearish than displayed, I'll give it to you. What about the tick? What about that tick? This is irregardless of where we are. I don't even know if that's a word. This is without regard to where we are in relationship to the prior day's close. This is tick by tick data, hence the name, right? What did the cumulative build do? Shows positive in the morning, little bit of a negative dipsy-do there, and then closes positive. I'm not arguing that this is a bullish data point. If it was bullish, would have closed positive 5,000 or better. Simply not the case. What I'm arguing is that this is not a bearish data point, which makes sense based on what we've been discussing, being in the midpoint of that overall daily balance range. If we take a look at the intraday chart here of the ES, I know it's rather small, but there's the bear flag, right? There's the breakdown. This, again, indicative of short-term momentum type traders, longer-term traders who are entering on a VWAP touch. They would be waiting for some give and take in the market, getting the best possible prices for their clients. This, again, momentum type trading, not indicative of larger players getting active just yet. All right, that's what I've got from a market internals perspective. Here's the market profile. If you don't know what this one is, top right hand corner's got you covered with a brief tutorial. Main takeaway here is quite simple. You can see clear as day 3 distributions on today's session. Where do we accept into tomorrow is the million-dollar question. If we're in the lower distribution, which I would argue is where we had the most acceptance based on volume, based on point of control, right? Value area is most overlapping with this lower distribution. Here is bearish in the short term. Remember, we're thinking about day trades from this perspective, right? We know we're neutral in the daily context. I don't have to keep repeating that. This is more bearish if we open in the lower third, more neutral opening in the middle third, and a little bit more bullish opening in the upper third, right? Threatening a break of the top of that daily balance area. Now, again, with the point of control closing weak towards the lower distribution, I'm not arguing that we just instantly go here. I'm really making the argument that things are much more neutral than some may perceive, and we still don't have big, strong new money sellers just yet. One of the things that I would mention as well that you need to be aware of from the market profile perspective is today's low. Today's low is also nuanced because underneath us, and again, this is something that you can only see from the market profile, look at the volume that happened here. If the stronger sellers were there, again, not only is this indicative of short-term momentum type traders turning it around, but stronger sellers would have had no issue moving through this really, really thin liquidity, probably down towards the point of control from the Monday session. So again, I'm not seeing the evidence that big new money shorts are just slamming this market short, looking for it to go to hell in a handbasket. I think that people are being patient. I think that this was momentum style type trading. Let's get back on over to the platform here and start peeking through our sectors. I'm going to turn off the anchored VWAPs here, and we'll start looking through the sectors. So overall, heavyweight sectors, right? XLK, heaviest of them all, down 2.37%, not great. XLF, second heaviest weight, down 2.28%, not great. XLV, third heaviest weight in our lineup, second by market cap, down roughly 1%. Of course, these are all going to read red from the open, considering most things faded off the open this morning, and this is going to read all green from the open. So it's really about what the structural charts are continuing to tell us from a trend-based perspective. We'll keep it brief. Still bearish bearish in the XLY. No acceptance over that 143, closing weak on the lows inside of the flag range from here. No positive developments. I would continue to think this is a threat for downside in our market. Heavyweight risk on sector doesn't look great. XLK, the heaviest weight sector of them all, steps in the right direction. Here's the balance area, primarily a breakout, and most of the day's session was spent above. However, there's the risk. Is this a look above and fail? Should the target be the bottom around 129.50? We will have to see. I think that this is kind of a sloppy area to resolve. If we look in the hourly time frame chart, notice how this is much more structurally sound here and here, as opposed to just assuming that the top of the range was the gap close area around 136.15. So yet to be determined. In here, neutral, above, save the day, below, you know the deal, probably targeting that 130 area down underneath. That's XLK, that's the heaviest weight sector, so that's why we spent the most time on it for today's video. XLF, lower high on the daily time frame chart, does not look great from a trend perspective, closing back down towards the flag lows in here. Again, the threat is, of course, underneath the flag lows through the thin structure to 33. That is a bearish data point for our S&P 500. XLI slowing down, yes, towards the highs, but this did actually produce a higher high, so slightly more bullish than the XLF. Watching to see what happens here at this inflection point, $100.55. Staying above keeps your market afloat, keeps us neutral. Falling back down underneath 99 is your primary concern for downside into 96, right? Very, very little structure in this chart here. This has been a significant mover for the most recent market rally. Keep an eye on your XLI. I would say the main look is 99. Next up is the XLC. Still a concerning look in this one. Here's your balance area on the daily, right to the top of the range. So equal high is in store, absolutely. From here to here is kind of like equal lows, higher lows-ish from that perspective. And it didn't close the gap all the way, so some relative strength based on that perspective. I would want to see continued price acceptance over 50.75 for more of a constructive look in communications. And if it breaks out over 52.17, maybe that's the beginning of the rotation. But as of right now, guilty until proven otherwise. Still too much of a threat to move back down here and just look weak underneath that 49.20. Next up, materials, really lightweight sector, technically producing a higher high, but closing right back in here. Again, some relative strength, not closing the gap all the way. Such a lightweight sector, I wouldn't read into it too much. Bearish really only gets concerning underneath 80. Bullish only, sort of positive drag, positive push, if you will, over 84.20. Not really all that important in materials. Consumer staples, equal high on the table, but closing right back down again at this inflection point. As we've pointed out in the past, one of the issues about having fairly accurate levels is that when you close right on them, it's pretty tough to determine what the chart wants to do. Technically, we've looked under the level and closed right back on it. I'd say continued acceptance over 76.50, neutral to bullish here. Remember that this is a D for defensive sector. You want to see it lag the market. So I'd actually prefer to see this stay here, possibly threaten the breakdown of 75.65, especially giving the XLY an opportunity to outperform. We'll look at that ratio in just a second. The pair that is. Utilities. What happens here? Big higher high, pullback, and closes outside of the Monday range, right? Outside of this prior high as well. This is a bullish look. There's no doubt about that. This is a bullish look for the utilities chart, which, as we know, is D for defensive. Not good for your S&P 500. So far, in looking at the sectors, things, although they did gap up, don't really look great from a structural perspective. XLV is technically D for defensive. Let me be very clear about that, but it is the second heaviest weighted sector in the S&P 500, so we need it to participate in rallies. But from a posturing perspective, the fact that it made a higher high and the fact that it closed fairly strong towards the top of the original balance here does strike me as slightly more defensive as opposed to a risk on look. It's certainly going to help push your S&P higher, don't get me wrong, and this paired with the XLK also flirting with a similar break of balance, right? Does look good, but the concern, of course, is the look above and fail. If we get more price acceptance underneath 140.16, bearish look probably drags the S&P lower into the remainder of the week. Next up is your XLRE, of course, on the inflation numbers coming in, the forecast that rates can eventually come in, starting to get a little bit of bullish lift here. Remember, it's a lightweight sector. It's not going to make or break the S&P. Has much more to do with the wealth effect and how people feel about their net worth, which has a direct impact on discretionary spending. So this moving in the upward direction actually may correlate to a better XLY. I'll have to do some study on that actually and see if we can put together a chart that displays that relationship. It may not even exist, but something that I'm watching as a possible correlation. XLE for energy, right? Playing around here. This is a decent look. We don't want it anywhere near these highs. It's playing nicely. It gapped up. It's, it held. It's the lowest on the list. It technically was down the least from the open. Little indecisive doji, but from a location perspective, as long as we're underneath 87.50, all good. Not really all that concerned about energy. Next up, let's take a look through the ratio pairings. See what's going on from this perspective. Top right-hand corner's got you covered with a brief tutorial. XLK, stride in the right direction. XLV, not good. XLF, not good. XLY, not good. Continuing to come off here. One of the four in the big risk on sectors, not a risk-on look for the market. Industrials continue to hold on, again, keeping the market maybe somewhat afloat. Communications trying to perk up, but still underneath the descending 50 SMA. XLP underneath the breakout, or right around the retest of the breakout level from the ascending triangle in the ratio. It's a better look, right? It's a better look here. It's not out of the woods yet. We're still above an upward sloping 50 SMA. Doesn't really look great for the market, but it's a step in the right direction. Energy still underneath that 50 SMA strikes me as okay. Utilities going sideways, not the best look, and real estate kind of sideways in here as well. Overall, certainly not in a risk-on environment, even after this morning's gap up. Let's take a look at the XLY over XLP. So again, this is that sort of pairing of growth versus value. Made new lows and continuing to make lows underneath this 1.88 and continuing to get rejected off of the resistance trend line. It's a really sloppy drawing. Let's do it again. Something that looks like this, right? So this, of course, is bearish for your S&P 500. We're not seeing the pickup we need in the XLY, which should be very, very clear based on that structural chart that we were just looking at. Next up is the dollar. Where is the dollar? Dollar's breaking down from 105, of course, with that inflation read being better than the expectation. So this, of course, is slightly positive for equities. I would continue to watch. The more time we spend underneath 105, the more meaningful it becomes. If we get back above, remember that may start to indicate more of an accumulation type phase. That's rounded bottom type, and then a remove back up into these highs. I don't think we're going there. I think that this was enough of a nail in the coffin to start sending the dollar lower. But just 105, 105, 105, 105. Continue to watch 105 underneath is a little bit more comfortable for equities. Let's take a look at the TNX, specifically the signal study. Something that we were concerned about in the weekly watch list video was the fact that our cross looked like it may have been coming for a move up from the bottom to positive on the signal here, the rate of change move, and we rolled over on today's session. That's, of course, on the expectations that the Fed will not have to be as aggressive with rates, considering what took place with the CPI read. So this actually does strike me as a little bit of a bullish data point for the market continuing to roll over there. Taking a look at the Fed Watch tool, what do we see here? Some really, really interesting developments in the Fed Watch tool. Not only has the terminal rate gone lower, you can see that now we're pricing in 475 to 500. Prior, as of just as recent as yesterday, it was up around 500 to 525. But look at how this is being held at these rates for longer, and then the first rate cut is actually coming later around November instead of the month of July. This is a really, really positive look for the Fed. Right? It doesn't, we were concerned about the rate of, the first rate cut being bumped up sooner to be sort of like a quote unquote bailout for the market. The fact that this is now being priced in as November, that's a step in the right direction from the Fed and what the market's expectation of the Fed really is as well. Maybe, again, this is sort of that, if we're looking at Jerome Powell and his indication for that quote unquote soft landing, this is a step in the right direction for that soft landing, right? So this looks much, much better than what we saw prior. Remember, stable rates are really good for the market. It's the volatility of raising them and cutting them and raising them and cutting them. That's what causes market turbulence. If you can just hold them somewhere, allows the market to relax, it adjusts to the current rate environment, and maybe, just maybe, we can do something, hint, hint, maybe start a clean trend at that point in time. Let's get back on over to the platform here, and what I want to show you is the CPI in relationship to some of the prior reads. Here it is. Top screen, top pane, so to speak, is the CPI. Here is the month over month. And if we switch to the white tool, there we go. Month over month and year over year. Expectation was here at 0.3, far undercut it 0.1 on the read there. Expectation was 7.3, undercut it by a few, 7.1 on the reading there. Again, what this would mean as we look at the Fed's curve, so to speak, of rates going forward. This is what we had as of Sunday. Now what's going on is that this should be pushed out to the month of November. We get 50, 25, hold, and then a cut in November, wherever that may be. I'm not going to pair it up on the axis, but this is a better curve than what was being priced in over the weekend. This is actually more bullish in terms of avoiding the earnings recession that we talked about in last video, right? So soft landing may be on the horizon. We will ultimately see, but things are definitely looking better after today's prints. Let's take a look at volatility because this, of course, is fairly important for our market. We know it's not off the table because 2 p.m. FOMC Fed funds rate and Jerome Powell's press conference, which usually causes a whole, bundle of issues there. But CPI VIX came in aggressively back to the 2050 floor, or at least close to it, undoing lots of the bullish pressure that was being put on here. This is more comfortable for our market. Remember that to avoid really more of the acceleration in the VIX, you're getting underneath 2050 is meaningful, especially off of some sort of lower highs. And if we pair that with a failed move in the VVIX, here we go. Outside of this range right here, so there's the failed move on Monday, we're certainly pushing up into that, upper edge. Don't get me wrong, it's still threatening the move higher, but it's not like we actually saw acceleration on today's selling pressure, right? So this is actually a step in the right direction in terms of how the VIX itself is responding to the market and the hedging that's taking place. It doesn't seem as though anyone is rushing out there to buy, SPY puts, VIX calls, and that also pairs nicely with what we've been saying on the SPY daily time frame chart, neutral until proven otherwise. I would imagine taking out 394.50 causes the VVIX to do something like this, and that's where we start to see more of that hedging activity take place. Let's take a look at our last volatility sort of screen here, which is the contango versus backwardation. Notice that we are in a strong, or not really strong, but we're coming back down. This is a step in the right direction into contango, meaning less risk in the present day than in the future, which means that money managers are happy to allocate capital. I've added in this here in case this is a little bit easier to understand. This is using the front and back month futures of volatility. This down below is the VIX 9-day. Oops, there we go. VIX 9-day versus VIX 30-day. Okay, so this is coming in as well. Steps in the right direction. This kind of pairs with this, and today coming in, today coming in. So steps in the right direction in terms of more comfort from a volatility perspective and less risk in the present look and more in the future, which again, just to reiterate, is good for money managers allocating capital. Let's take a look at the QQQ. What's going on from the NASDAQ perspective? Certainly very similar to the XLK. A little bit more of a look above and fail confirmation, though, closing firmly in the midpoint of this range. I will still argue that this is a step in the right direction, being above the original balance. Remember that this was the problem area for quite some time. As long as we're above 281.25, again, treat it just like the ES, just like the S&P. If we're in the midpoint of this range, you don't really have much of an edge. Edge will exist here. Edge will exist here. In the midpoint, scalps back and forth, absolutely intraday basis only. But any larger market direction, not really going to exist. That upper level, by the way, is 293 roughly, right around in here. So same idea as well with the gap close and reversal right off of the level, more indicative of short-term momentum type traders, not big new money sellers slamming the market short here. Last but not least is the IWM, where we will actually learn much more about the market than the QQQ. This is clearly divergent. Hopefully you made it to the end of the video because I cannot understate the importance of this one enough. The fact that the IWM did not make an equal high or higher high on today's session. It rejected off of the prior resistance that we knew from the midpoint of the range, and it closed fairly weak at the bottom end, 181.10, does strike me as a bearish indication. If this gets underneath 181.10, huge red flag for the markets. Continue to look for those possible bearish outcomes in the SPY underneath 394.50. This is an issue. The fact that small caps are or had acted as a leader here, and up here as well, and are now signaling, hey, a little bit more weakness, this is an issue. So balance all of the data points. I think we've gone through and been fairly comprehensive in the broad market. The sectors are still positioned in seemingly, more bearish tone than bullish tone, defensive tone than risk on tone. The IWM's kind of an issue. We're seeing some bullish data come out with the Fed and possibly more of the fundamental narrative of the market. We're a little bit more neutral on the SPY. I think we'll learn something tomorrow based on what FOMC does for our markets. Everybody stay safe out there in terms of the FOMC. Remember that in the midpoint, I can't stress this enough, you just don't have an edge. So if you're a scalper, use an intraday stop. If you're not, just don't worry about the market. You don't have to trade this incredibly tough action right in here, especially surrounding an economic data drop. So that's what I've got for you on today's video. We will, of course, be live tomorrow morning at 8:30 to kick off the pre-market live stream, and I'll give you the update video tomorrow afternoon as well, once the market has closed and the dust has settled from the FOMC. With that said, everybody, have a great night. I'll see you in the live stream tomorrow, and if you don't tune in, that's okay. I wish you a green trading week.